So let me start by asking you a little bit about policy. Indonesia, which was as aggressive as the Philippines in tightening last year, has started to become a little less hawkish following the dovish pivot from the Fed. Is a policy rate cut on the cards for the Philippines at all this year?
Well, we choose to be more cautious than that. We need to see more observations that would show us that inflation is indeed on a downward trajectory. There's still a lot of volatility in the both in the foreign exchange market and in the money market. And we need to see also how inflation expectations are fanning out. We saw in 2018 that inflation expectations were beyond the 2 to 4% inflation target of both the government and the Bangko Sentral ng Pilipinas. So we need more time to digest what is unfolding before our eyes. We did 175 basis points increase in the policy rate of the central bank last year, and we want to make sure how this tightening work itself out through the banking system and the real sector, including the labor market.
So you want to see how the data plays out. I understand that. Of course, all central bankers do. So at the moment, would you say that you're more on pause, or is the bias a little bit more to the hawkish or the dovish side?
Well, we are more on the hawkish side in the sense that we recognize the risks in the market. We recognize the possibility of oil prices surging again. So we are trying to be more cautious about these potential risks that could impinge on our ability to maintain price stability in the Philippines. We want to make sure that we have the benefit of time and more observation that indeed there is really a trend towards a leveling off of inflation in the next 2 years. Based on our forecasts, inflation is expected at 3.1% in 2019 and 3% for 2020. But we need to validate these numbers.
OK, so in that sense, it sounds like perhaps a bias towards easing is not really likely before 2020.
Well, anything can happen between now and 2020. So it is very difficult to paint ourselves in the corner.
Fair enough. Now, some analysts are expecting that the Bangko Sentral to trim bank's reserve ratio as early as this year. That, of course, would be following up on the 2 percentage point cut last year. When is the right time this year, in your view, to resume this reduction?
Well, there is always a time for everything, and we are waiting for the right time before we can adjust the reserve requirement to a lower level from the present level of 18%. First, we need to see that such a reduction in reserves will not impinge on domestic liquidity. As you know, we want to make sure that we have appropriate level of liquidity in the market so as not to complicate the conduct of monetary policy. We want to make sure that prices remain stable and inflation remains firmly entrenched in the 2 to 4% inflation target of both the government and the BSP. Second, we have to make sure that indeed there is tightness in the market. Right now, there is very little evidence of that tightness in the market. In our own term deposit facility alone, on a weekly basis, we see oversubscription across the 3 tenors. 2, if we look at the growth of credit and liquidity, they are fairly reasonable. In other words, the growth of credit and domestic liquidity continues to be consistent with economic growth and the kind of target that we wish to achieve as far as inflation is concerned. Most important, I think we have to make sure that our move on the reserve requirement will not affect inflation expectations. For every 100 basis point reduction, we will be releasing 100 billion pesos to the system. And that could be inflationary, all other things being equal.
Okay. Mr. Guinigundo, the peso's up some 0.9% this year after dropping 5% in 2018. It is lagging gains, though, in the rupiah, in the ringgit, and also the baht. How comfortable are you with the level of the currency right now?
Well, the exchange rate of the peso is determined by market forces. And we saw, starting in the last quarter of the year, through the first 2 months of 2019, the substantial inflow of foreign exchange coming from remittances, from BPOs, also from tourist receipts. On top of that, we have also seen sizable inflows coming from foreign direct investment, as well as foreign portfolio investment. This is something that is driving the strength, the resiliency of the Philippine peso against the US dollar. On top of that, there is also the stability that is provided by good macroeconomic fundamentals that we are seeing today. Inflation, for example, has come down from a peak of 6.7% in September 2018 down to only 4.4% in January 2019. Gross international reserves also rose by more than $3 billion from $79 billion at the end of December 2018 to more than $82 billion at the end of January 2019. These numbers are providing support to the currency.